Hey guys, so today we're going to talk about breaker blocks, how to integrate breaker blocks into your swing trades to place higher probability trades, to get more accurate entries, and to give you more context as to where there might be areas of liquidity on your charts that you can use as fuel to actually enter those higher probability trades. Very quickly, we're just going to touch on the definitions of a breaker block. So a breaker block is an order block that gets disrespected and then flips to become the opposite type of support or resistance. So in this example, you have this supply zone, what would be a supply-based order block, whereby there was a buy candle, sell through the candle. So what we'd expect to see is that price mitigates this at this point order block to go lower. What ends up happening is that price just trades through, and then basically you can use this level right here to take trades higher, because you've essentially got what is a break of resistance or a flip zone that broke through that order block and represented that there was more demand in the market than supply. So why do breaker blocks form? We could spend ages on this, but essentially, as always, it's around liquidity. It's liquidity collection for big actors in the market. They're enticing sellers or buyers into the market with the formation of order blocks, and then in a lot of cases, just those resistance or supply support zones just get traded straight through. And then essentially what's happening is that any traders that were entering positions at that area get trapped in those positions, and then what those actors don't want to happen is to give a point where those traders can get out of their positions before the market takes off. So instead of price retracing back into a fair value gap or an order block, or right down into that price leg, price just takes off and gives you no opportunity to exit unprofitable positions. But visually on your candlestick charts, what that looks like is a flip zone or an area whereby there was support or resistance that got traded through quickly and then acts as a corresponding support or resistance zone. So let's just bring this to life actually on the chart, because this is obviously always where you get the best representations of this. So in this particular area, you see that price is bearish, and you have this order block formed. So if we just look at this quickly, we have a 12-hour order block that has formed in this area here. So what we would expect to see is just a continuation of this trend. You've got a bearish fair value gap, bearish order block. So we'd expect to come in here and then continue lower. And that could be where traders are looking to get into positions, either from the order block or potentially position traders that want to cover the weekly high and look for trades lower. Maybe it's like a 1-to-1 target, or if you're looking at the order block, more aggressive RR targets. But what happens, instead of that level being respected, it gets traded straight through, completely disrespected, and then you see this area here then acts as the corresponding support, not straight away, but for higher prices. And actually, it never gets disrespected. Even when there's a sell-off here, price continues higher. So if you got into a trade, either from the order block, you might be stopped out straight away, or if you're trying to get into more of a position type trade, you never get an opportunity below this level, this entry point, to exit your trade. It becomes almost like a floor in the market, a flip zone, if you will, to actually take trades higher. And the reason is that the actors in the market that are distributing or collecting orders at this point, they don't want to give anyone that got into trades here the opportunity to get out. It's trapping traders into their positions. So that's a breaker block. It's areas whereby you had an order block that turns into a zone that then acts as support for a corresponding move in the opposite direction. So that's how to identify breaker blocks. And importantly, we now want to understand how to actually trade breaker blocks. And as always, you need that higher time frame context, you need confirmation, and in a lot of areas you also need order flow as well to ensure that you're getting into trades and using breaker blocks in the right way. So if we just take this example here, USD JPY, and we just talk more about what's happening here. So here we have we're looking at a 2-week candle on the higher time frame right here. So I have an indicator here which is showing me the 2-week time frame behind my execution time frame. So obviously we're looking at swing trades here. So we've got the 12-hour whereby we're looking at this 2-week price action behind the chart. So you can see we had 2-week candle form here, 2-week candle form here, sell off, and then we have this shift. So what we see at this point is order blocks being respected. So we've got 12-hour order block right here. Then we get this sort of consolidating price action. We get a new 12-hour order block right here. And then we eventually get this order block here. We also have, if you want to just make this explicit, this bearish fair value gap. So we've got order block formed, we've got a bearish fair value gap. Then, as I say, what happens is that price continues lower and then just trades straight through all of these internal resistance or liquidity areas. So disrespects in one movement the fair value gap. It also disrespects the order block, which is formed right here. So what we can then do is mark the corresponding order block as a breaker block, or a level in the market that we think is going to be respected. So here I've got 12 breaker. So this is a point in the market that we think is going to act now as support for higher prices. What we've also done with this shift is liquidated a 2-week candle's low. So I'm just going to mark this as a 2-week turtle soup. And we'll talk about, there's further videos that you can watch on my channel that talk about liquidations of candles. But essentially, we're now looking to trade this candle range, whereby we had a bearish candle, price swept below this candle's low, and then we had an order flow shift, whereby we had bearish price action in, bullish price action out, and we have the formation of a breaker block in the form of a disrespected order block. So you could then use this covering the low as your entry point to target higher, and that's exactly what ends up happening. So it might be that you want to hold for this high for a full completion of this CRT in this instance, or you might be looking for highs within this leg down here. But you can see that plays out as a 3.47 R trade. It's always important to use breaker blocks in conjunction with what's happening in the actual price leg, because you can see that there's a formation here of a bullish order block. There is also a fair value gap here at the base of this price leg. And what ends up happening here is that you get this almost like fake out, this bearish shift that is enticing people back into sell positions. But then you get this shift out in a bullish sense again, and then price takes off. So you could have taken an order maybe off this order block right here, which would have been a valid trade, because you have this price leg higher to get a 10R multiple potentially. But what breaker blocks give you in a lot of instances is a larger area with less need for accuracy to still take advantage of those swings. So you can play with this, and we can talk about this in a bit more detail. But it gives you the ability to get into trades without having to wait for maybe like a mitigation of these areas. that are a lot lower in the price leg, because if you'd have waited for the fair value gap or the order block, you just wouldn't have been tagged in. And the reason for that is that price is never going to trade below this level, because essentially we want to, or the market wants to trap anyone, as I say, that initially got into bearish or sell positions at this level. So this is just like a chart example of a breaker block. I want to run through another example right here, which is also a great representation of a breaker block and a cleaner entry as well. So the exact same thing actually happens here. Now we're looking at GBP CAD, and I've just kept things simple by also using the 2-week time frame. So we have this price action in the market whereby the order blocks get formed here. We've got bearish action in the market. We get a sell-off, new order block created, new price leg created, bearish, and then we get this this last order block that actually gets disrespected right here. So price trades in, looks like it's going to go lower, and then what happens? It just gives you no opportunity to get out. If you're getting into a trade right here, maybe you're targeting this low here. You saw a liquidation of these highs here, and you're targeting this low. You might be in a trade that looks like this to this low. What happens? It nearly gets there, but then it reverses, and then you get a little move and then a big shift, but it happens very quickly. There's aggressive action through this area. And so what happens is you get this shift, this market structure shift, whereby you now see bullish price action. And again, what gets respected? It is the order block that gets flipped. So this then becomes that resistance zone. When price never trades back below this, this level here, which is where a lot of people or a lot of market participants will be looking to get into short positions. So again, you could just use this breaker block as your entry, covering the low, covering the liquidation of that level, and target the high. Now, why does this become an even higher probability trade? Because in this shift and the close of this candle, we see again that we've liquidated this 2-week level. So we'll just go and mark that. So at the close of this candle here, you can see accumulation candle, price manipulates below the candle, exposing the previous candle's high as a target in the market, or even these highs here. And the breaker block can be used to get a more refined entry. So you can still do this if you really want to, and you've still got a very profitable swing trade, or maybe you want to just cover that order block there, and you've still got a 2-to-1. But for a more accurate entry in the market, you can just use the breaker block, and you've got a 3.5 plus R trade to the highs. What you should also do is just look for further areas of support, because in this instance, you also have a 12-hour order block right here. So you can see this sell to buy, sell to buy. You also have a fair value gap right here. So you can become even more accurate with your entries depending on your trading plan. Maybe you only trade from fair value gaps, in which case your trade might look slightly different, might look more like this. But equally, you're giving away a lot of space in your stop loss that maybe you didn't need to, because you have this logic, this area of original supply, which is flipped into a flip zone or breaker block that you can actually use as your fuel for higher prices. So again, that's how to trade order breaker blocks. They can just give you more refined entries and often more space in your entry to be wrong or right without actually getting stopped out, because you have that logic that price is never going to trade below this level, because it's not going to let those people that wanted to get into sell positions here out of their positions before we have much higher prices. So again, that's how to use breaker blocks. They're just another point of internal range liquidity that you can use to enter and exit positions in the market. We've talked a bit about breaker blocks versus order blocks. I think a lot of the time, the benefit of breaker blocks versus order blocks are that if we take this example here, if you were waiting for an order off the order block, this would be completely valid. You've got the shift, you're looking for a retracement into this area, but it never comes for the reason that we talked about. So you're missing trades, you're missing this price action here. Sometimes it makes sense to hold for the order block or hold for a fair value gap lower down in the price leg. But if you see this type of price action where there's clearly like a very aggressive move through an old order block, this often will be the floor for price. It will never trade below this level for that reason that I mentioned. It's about trapping liquidity. And so if you're sat here waiting for an order block to be tagged, yes, you could get a much stronger R multiple in your trade, but you actually end up never getting tagged into the position because you're sat waiting. Common mistakes. Trading breaker blocks against higher time frames is always, like any type of trade, really not recommended. You need to combine breaker blocks with higher time frame candles and trade ideas, often around liquidating old highs and lows for them to be very effective. It's not about just waiting for a breaker block to form and then trading it because there's been that shift, because it could be that price is just coming up to manipulate above a high here, and actually you are going to see that continued move, and the breaker block just fails. So it's about combining the formation of breaker blocks with the fact that we've had these higher time frame liquidations and price has a reason to then reverse. If price has no reason to reverse in the first place, then it could be that the breaker block is just forming to entice you into your position so that you can be manipulated out of that position. So it's really important to combine breaker blocks and the formation of them with higher time frame trade ideas. Like everything, don't trade breaker blocks in isolation, and don't just forget other areas of internal range liquidity. Always track your breaker blocks alongside swing points, fair value gaps, order blocks, and enter and set your stop loss based on how price is forming at those levels, and ensuring that there aren't areas of liquidity necessarily that you could get stopped out of below your stop loss before the move actually happens. So that's breaker blocks in a nutshell. We'll talk about them in more detail, and I reference breaker blocks in a lot of other videos that I'm putting out, which talk more about how to time these high probability trades. But they're definitely something that I use and track in my trading, and they can give you very accurate ways to get into high probability multiple R trades, especially when it comes to swing positions. See you on the next one, guys.